Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Hello and welcome. Have you ever found yourself staring at a bank statement, a credit card bill, or a retirement account summary and felt a little lost? Maybe you've asked yourself questions like, am I doing this right? Am I saving enough? How do I even begin to plan for a future that feels so far away and uncertain? If you have, you're not alone. The world of personal finance can often feel like a complex maze, full of confusing jargon, endless options, and the constant pressure to make the right decision. This is where the idea of a finance expert comes in, a professional guide who can help navigate that maze. But what does a U.S. finance expert actually do? For many, the term might bring to mind an image of a Wall Street trader in a suit, shouting into a phone, or perhaps a stern-faced accountant surrounded by piles of tax forms. While those are pieces of the financial world, the reality for most people seeking financial guidance is far more personal and collaborative. Before we dive deep into this topic over the next several chapters, it is essential to state clearly: this content is for informational and educational purposes only. It is not intended to be a substitute for professional financial, investment, legal, or tax advice. The goal here is to demystify the roles of financial professionals and empower you with knowledge. Always consult with a qualified professional for advice tailored to your individual situation. So, let's start with a foundational understanding. Finance expert isn't a single job title. It's an umbrella term that covers a wide range of professionals, each with their own specializations. Think of it like the medical field. You have general practitioners, surgeons, cardiologists, and dermatologists. You wouldn't see a dermatologist for heart surgery. Similarly, the financial world has certified financial planners or CFPs, who look at your entire financial picture, chartered financial analysts or CFAs, who specialize in investment analysis, certified public accountants, or CPAs who are experts in tax and accounting, and many others. Throughout this series, we will explore these different roles in detail. But for now, let's focus on the central question: why does someone need a guide in the first place? The core function of most client-facing finance experts is to help individuals and families align their money with their life goals. They are part financial strategist, part educator, and part accountability partner. Their job begins not with numbers, but with you. They want to understand what you want to achieve. Do you dream of buying your first home in 5 years? Are you focused on paying for your children's college education without taking on massive debt? Do you want to ensure a comfortable and secure retirement? Or perhaps you've recently come into an inheritance and have no idea how to manage it responsibly. These are not just financial goals. They are life goals. Money is simply the tool you use to build that life. A finance expert's primary role is to help you use that tool effectively. They do this by creating a structured plan, often called a financial plan. This isn't just a budget. A comprehensive financial plan is a roadmap that looks at where you are today, where you want to go, and the specific steps needed to get you there. One of the biggest misconceptions is that financial experts are only for the wealthy. This is simply not true anymore. While wealth management for high net worth individuals is certainly a part of the industry, many professionals focus on helping everyday people organize their financial lives. They can help a young person create a plan to tackle student loan debt, guide a growing family in balancing saving for retirement with day-to-day expenses, or assist someone nearing retirement in understanding how to turn their savings into a steady income stream. So, what does that process look like in practice? Typically, it starts with a deep dive into your current financial situation. A professional will help you gather information about your income, expenses, assets, like savings and investments, and liabilities, like mortgages or loans. This isn't about judgment. It's about establishing a clear starting point. It's impossible to draw a map to your destination if you don't know where you are on the map right now. From there, the expert works with you to clarify and quantify your goals. Saying, "I want to retire comfortably" is a great start, but a professional will help you define what comfortably means to you. How much income will you need each year? What lifestyle do you envision? By putting concrete numbers to these goals, they become real, tangible targets rather than vague dreams. With a clear picture of your starting point and your destination, the expert then helps you build the strategy. This involves a wide range of areas. They will look at your cash flow and budgeting, helping you understand where your money is going and identifying opportunities to save more effectively. They will analyze your insurance coverage to make sure you and your family are protected from unexpected events. They'll discuss basic principles of investing, explaining concepts like risk tolerance and diversification in plain English. They will also touch upon long-term planning, such as estate planning, to ensure your assets are handled according to your wishes. In essence, a U.S. finance expert translates the complex language of money into a personalized action plan. They provide structure in a world that can feel chaotic, offer an objective perspective when emotions might cloud your judgment, and provide the education you need to make confident financial decisions. They aren't there to make decisions for you, but to empower you to make informed decisions for yourself. In our next chapter, we will break down the first fundamental building block of any solid financial future: creating a meaningful budget and mastering your cash flow, and the specific ways a financial professional can guide you through that foundational process. Welcome back. In our first chapter, we introduced the concept of a finance expert as a guide through the complexities of your financial life. We established that their primary role is to help you build a roadmap from where you are to where you want to be. Today, we're going to explore the very first step on that map: understanding your financial starting point. For many, this brings to mind a word that can cause a bit of anxiety: budgeting. The word budget often feels restrictive, like a financial diet that cuts out everything you enjoy. But in the hands of a skilled financial professional, a budget is not a tool of restriction, it's a tool of illumination. It's less about saying no to your spending and more about empowering you to say yes to your most important goals. A finance expert doesn't see a budget as a list of things you can't have. Instead, they see it as the diagnostic tool that provides a clear, honest picture of your financial health. As always, please remember this discussion is for educational purposes only and does not constitute financial advice. We are exploring the processes and roles of financial professionals. For personalized advice, always consult a qualified expert. So, how does a professional guide someone through this process? It begins with a phase of pure discovery, free of any judgment. An expert will encourage a client to track every dollar that comes in and every dollar that goes out for a certain period, typically a month or two. The goal here isn't to immediately change habits, it's simply to gather data. Think of it like a doctor running tests before making a diagnosis. They need accurate information to understand what's happening. In the past, this meant saving receipts and writing everything down in a notebook. Today, it can be done with simple spreadsheets or various financial apps that link to your accounts. The specific tool is less important than the act of observation itself. Once that data is collected, the next step is analysis. This is where a professional's objective viewpoint becomes incredibly valuable. They help you categorize your spending. You'll typically group expenses into three main buckets: fixed expenses, which are the same every month, like a mortgage or a car payment; variable expenses, which change, like groceries, gas, and utilities; and discretionary expenses, which are often your wants, like dining out, entertainment, and hobbies. By organizing your spending this way, patterns begin to emerge that you might not have noticed on your own. A finance expert can help you see these patterns clearly. They might point out, it looks like about 20% of your take-home pay is going toward food, including both groceries and restaurants. How does that align with what you expected? Or, I see a number of small, daily subscription services. Individually they are small, but together they add up to a significant monthly expense. The expert's role is not to say whether this is good or bad, but to hold up a mirror to your financial habits and help you understand them. This process naturally leads to a more dynamic concept that professionals prefer over the static word budget. That concept is cash flow. Cash flow is simply the net amount of cash moving into and out of your financial life. Your income from your job and any other sources is your cash inflow. All of your spending is your cash outflow. When your inflow is greater than your outflow, you have a positive cash flow. This surplus is the single most powerful tool you have for building wealth and achieving your goals. Without a positive cash flow, it's nearly impossible to save, invest, or pay down debt effectively. Once your cash flow is understood, the finance expert's role pivots from diagnostician to strategist. This is a critical point. A true professional will not dictate what you should change. They will not hand you a rigid budget and tell you to follow it. Instead, they will use your own goals, the ones you defined as being most important to you, as the framework for making decisions. They facilitate this by asking powerful, open-ended questions. For instance, if your goal is to save for a down payment on a house, the conversation might sound like this. We've identified that you have a monthly cash flow surplus of $300. To reach your down payment goal in 3 years, we'll need to increase that surplus. Looking at your spending categories, which areas do you feel you could adjust without significantly impacting your quality of life? This approach puts you in the driver's seat. It transforms the process from one of deprivation to one of conscious, intentional alignment. You are not cutting back. You are reallocating your resources towards something you want more. An expert might introduce you to common frameworks to help structure this thinking, like the popular 50/30/20 guideline, which suggests allocating 50% of after-tax income to needs, 30% to wants, and 20% to savings and debt repayment. They might also discuss a zero-based budget, where every single dollar of income is assigned a job, ensuring no money is wasted. They present these as tools and educational concepts, helping you find a system that works for your personality and lifestyle. Finally, a finance expert understands that money is deeply emotional. Our spending habits are often tied to our feelings, our upbringing, and our values. A professional provides a safe, confidential space to talk about these things. They act as a behavioral coach, helping you recognize emotional spending triggers and develop healthier financial habits over time, providing accountability and encouragement along the way. In summary, when it comes to your daily finances, an expert's role is to help you replace confusion with clarity and financial anxiety with financial control. They guide you through creating a system that reflects your values and actively works toward achieving your most important life goals. Welcome back. In our last chapter, we transformed the idea of a budget from a restrictive chore into a powerful tool for understanding your cash flow. We established that creating a surplus, where your income is greater than your expenses, is the engine that powers your entire financial journey. But once you have that engine running, where do you direct its power first? This is where a financial expert's guidance becomes critical. They will tell you that before you start building the skyscraper of your financial future through investing, you must first lay a rock-solid foundation. That foundation consists of 2 essential parts: a financial shield to protect you from the unexpected, and a strategic plan to clear away the weight of debt. Today, we'll explore how a finance expert guides you through building both. As a reminder, this series is for informational purposes only. The concepts discussed are meant to be educational, not to serve as personalized financial advice. Please consult with a qualified professional to address your specific circumstances. Let's start with the shield, the emergency fund. A finance expert knows that life is unpredictable. A car breaks down, a furnace needs replacing, or an unexpected medical bill arrives. For someone without a safety net, a simple $1,000 emergency can easily spiral into high-interest credit card debt, derailing years of financial progress. The emergency fund is the buffer that turns a potential crisis into a manageable inconvenience. Its sole purpose is to protect your long-term goals from short-term surprises. So the first question an expert will help a client answer is, how big does this shield need to be? You may have heard a general rule of thumb to save 3 to 6 months' worth of living expenses. A professional uses this as a starting point for a deeper conversation. Their real value is in helping you personalize that number. They will ask probing questions to tailor the fund to your life. For example, how stable is your income? Is your job in a volatile industry, or is it very secure? Someone with a less predictable income, like a freelancer or a commission-based salesperson, might be guided to aim for a larger fund. Another question might be, what is your insurance situation like? Someone with a high-deductible health plan may need a larger cash reserve to cover potential medical costs. They'll also consider your dependents. Do you have children or other family members who rely on your income? The goal of this dialogue is to arrive at a target amount that doesn't just follow a generic rule, but provides you, the individual, with genuine peace of mind. Once the target is set, the next piece of guidance is on where to keep these funds. A professional will stress that this money has a specific job: to be there when you need it. Therefore, it must be kept in an account that is safe and liquid. Liquid means you can access the money quickly and easily without penalty. Safe means the value won't drop due to market fluctuations. This is why an expert would explain that an emergency fund should not be in the stock market. Instead, they would describe the characteristics of appropriate accounts, such as a high-yield savings account, which is separate from your regular checking account to reduce the temptation to spend it on non-emergencies. With the defensive shield in place, the expert then helps you move to the offensive, creating a strategy for tackling debt. For many people, debt is a source of significant stress and shame. A good professional immediately removes that emotional weight. They frame debt not as a personal failure, but as a financial challenge with a clear, mathematical solution. The first step is to get organized. An expert will guide you to create a comprehensive list of every single debt you have: student loans, car loans, credit cards, personal loans. For each one, you'll identify the total balance, the interest rate, the APR, and the minimum monthly payment. This simple act of putting everything on one page can be incredibly empowering. It takes a vague, stressful cloud of debt and turns it into a defined list of problems that can be solved one by one. Once everything is organized, the expert transitions into the role of a strategist. They will typically educate the client on the two most effective and widely recognized debt repayment methodologies. The first is often called the debt avalanche. They will explain that this method focuses on interest rates. You continue to make the minimum payments on all your debts, but you direct every extra dollar of your cash flow surplus toward the debt with the highest interest rate. Once that debt is paid off, you take all the money you were paying on it and avalanche it onto the debt with the next highest interest rate. The expert will clarify that from a purely mathematical perspective, this method will save you the most money in interest payments over time. The second methodology is known as the debt snowball. A professional would explain this as a strategy focused on behavior and motivation. With this method, you again make all your minimum payments, but you direct your extra cash flow toward the debt with the smallest total balance, regardless of the interest rate. When you pay off that small debt, you get a quick psychological win. This motivates you to keep going. You then take the money you were paying on that debt and roll it, like a snowball, into the payment for the next smallest debt. Crucially, a financial professional will not tell you which method to use. Their job is to educate. They will explain the pros and cons of each, the mathematical efficiency of the avalanche versus the motivational power of the snowball. Then, they will facilitate a discussion to help you decide which approach best fits your personality. Are you motivated by pure numbers, or do you need those early victories to stay on track? The best plan is always the one you will actually stick with. By guiding you to build an emergency fund and implement a clear debt repayment strategy, a finance expert helps you construct a stable platform. This foundation gives you the confidence and the financial capacity to move on to the next, more exciting phase of your journey. In our next chapter, we will explore that phase. With a solid foundation beneath you, how does a finance expert begin to introduce the principles of making your money work for you? We will delve into the world of investing. Hello and welcome back. In our previous chapters, we laid a critical foundation. We moved from understanding your cash flow to building a financial shield with an emergency fund, and creating a clear strategy to manage debt. With that stable platform in place, you are now in a position to look toward the future and begin making your money work for you. This brings us to the topic that most people associate with finance: investing. The world of investing can seem intimidating. It's an alphabet soup of acronyms: stocks, bonds, ETFs, 401ks, and is often portrayed as complex and risky. This is where a financial expert's role as an educator and a guide is perhaps most vital. Their first job isn't to pick investments. It's to help you understand the fundamental principles that govern smart, long-term investing. They are there to replace fear with knowledge and speculation with strategy. Before we proceed, it is essential to reiterate our standing disclaimer. This content is for educational and informational purposes only and is not investment advice. Investing involves risk, including the potential loss of principal. Always consult with a qualified financial professional who can provide advice tailored to your personal situation. A professional's first conversation about investing with a client rarely starts with talking about the stock market. It starts once again with you. Specifically, they focus on 3 key pillars that will define your entire investment philosophy: your time horizon, your goals, and your risk tolerance. First, let's talk about time horizon. This is simply how long you plan to invest your money before you need to use it. A finance expert will explain that time is the most powerful ingredient in any investment strategy because it allows for the magic of compounding. They might illustrate this with a simple example, showing how an investment can grow exponentially over decades versus just a few years. They would guide a client to see that money being saved for retirement in 30 years can be treated very differently from money being saved for a house down payment in 3 years. A longer time horizon generally allows for a different approach to market ups and downs compared to a shorter one. Second, the expert will connect investing directly to your goals, which we've discussed before. Are you investing to generate income in retirement? To achieve growth for a major future purchase? To preserve the wealth you already have? A professional helps clarify that each of these goals may be best served by a different strategy. Investing without a clear goal is like sailing without a destination. You're moving, but you don't know where you're going. The third and perhaps most important pillar is risk tolerance. A financial expert will help a client understand that risk and potential return are two sides of the same coin. Generally, investments with the potential for higher returns also come with higher risk of loss, and vice versa. An expert's job is to help you determine how much risk you are both willing and able to take. This is a two-part discovery process. Your willingness to take risk is your emotional comfort level with watching your account balance fluctuate. An expert might ask questions like, if the market dropped 20%, what would your first instinct be? Would you feel anxious and want to sell? Or would you see it as a potential opportunity? This helps gauge your emotional response. But just as important is your ability to take risk, which is based on your objective financial situation. This goes back to your time horizon, the stability of your income, and the strength of your financial foundation. Someone with a long time horizon and a secure job has a greater ability to withstand market volatility than someone nearing retirement. A professional helps you find the right balance between your emotional comfort and your financial capacity for risk. Once these pillars, time horizon, goals, and risk tolerance, are established, the expert then educates the client on the core strategies used to manage risk. The most fundamental of these is diversification. You have likely heard the phrase, "Don't put all your eggs in one basket." That is diversification in its simplest form. A professional would explain this concept by talking about different asset classes, broad categories of investments like stocks, bonds, and cash. They will teach you that these different asset classes often behave differently under the same economic conditions. By spreading your investments across them, the goal is to smooth out the ride, so that a downturn in one area of your portfolio is potentially offset by stability or gains in another. The expert's role is to explain what these asset classes are, and the role each one can play within a portfolio. Building on that is the concept of asset allocation. This is the practical application of diversification. Based on all the discovery work, your goals, time horizon, and risk tolerance, an expert would help you understand how you might decide on a specific mix of asset classes. For instance, they would explain why a younger investor with a high risk tolerance and a long time horizon might have a portfolio with a higher allocation to stocks, while an investor nearing retirement might have a higher allocation to bonds and cash to preserve capital. They are not telling you what to do, but are teaching you the logic behind how these strategic decisions are made. In essence, a financial expert's initial role in investing is that of a teacher and a coach. They demystify the process, build your confidence, and ensure you have a solid understanding of the core principles. They help you build a personal investment philosophy grounded in your own life, not in chasing market headlines. In our next chapter, we will take these principles and explore the different types of investment vehicles, like mutual funds, ETFs, and retirement accounts, that a professional would educate you on as you begin to put your strategy into practice. Hello and welcome back. In our last chapter, we established the core principles an expert uses to build a client's investment philosophy, understanding their time horizon, goals, and risk tolerance. With this personal framework in place, the next step is to learn about the actual tools you can use to implement that philosophy. This is where a professional's role shifts to that of an educator, explaining the different types of accounts and investment products available in the U.S. financial system. Their goal is to demystify the jargon and help you understand the purpose of each tool in your financial toolkit. They'll explain the what and the why so you can have an informed conversation about your strategy. As always, we must state that this is for informational purposes only, and is not a recommendation or endorsement of any specific account or product. The tax implications of these accounts can be complex and depend on individual circumstances. This is not tax advice, and you should always consult with qualified financial and tax professionals. First, an expert will likely explain the concept of an investment account. Think of an account as the container, and the investments as the things you put inside the container. The type of container you choose often comes with specific rules and potential tax advantages. One of the most common types of accounts a professional will discuss is the employer-sponsored retirement plan, like a 401k or a 403b. They'll explain that this is a benefit offered by many companies that allows employees to save for retirement directly from their paycheck. A key feature they would highlight is the concept of an employer match. An expert would describe this as an incentive from the employer, where the company contributes a certain amount to your account based on how much you contribute. They often frame this as one of the most powerful wealth-building tools available, as it offers an immediate return on your contribution. Next, they would introduce you to individual retirement arrangements, or IRAs. An expert will explain that these are accounts you can typically open on your own, separate from an employer. They serve the same purpose, saving for retirement, but offer more flexibility in investment choices. Here, a professional would educate you on the two main types of IRAs, the traditional IRA and the Roth IRA. Their explanation would focus on the key difference: how they are treated for tax purposes. They would describe a traditional IRA as a tax-deferred account. This generally means that contributions might be tax-deductible in the present, which could lower your taxable income today. The investments inside the account then grow over time without being taxed annually. Taxes are then paid on the money when it is withdrawn in retirement. In contrast, they would describe a Roth IRA as a tax-advantaged account that works in the opposite way. Contributions are made with money that has already been taxed. The key characteristic an expert would highlight is that the investments can then grow tax-free, and qualified withdrawals in retirement are also tax-free. A professional's role here is not to say which is better, but to educate on the concepts of pay taxes now versus pay taxes later. They would facilitate a discussion around a client's current and expected future financial situation to help them understand which structure might align better with their long-term plan. Now let's talk about what goes inside these containers. This is where an expert explains investment products. For most people, a professional will introduce two of the most common ways to achieve diversification: mutual funds and exchange-traded funds, or ETFs. They will explain that both mutual funds and ETFs are essentially baskets that hold a large number of individual investments, like stocks or bonds. This provides instant diversification. By buying a single share of a fund, you are effectively buying tiny pieces of all the different companies held within that basket. A financial expert would then clarify the key differences. They would typically describe a mutual fund as a product that is priced and traded only once per day, after the market closes. They might also explain that many mutual funds are actively managed, meaning a professional fund manager is actively buying and selling investments within the fund, trying to achieve a specific objective, like outperforming a market benchmark. An ETF, on the other hand, would be described as trading like a stock. It can be bought and sold throughout the day on an exchange, and its price will fluctuate accordingly. The expert would also explain that many ETFs are passively managed. This means they are designed to simply track a specific market index, like the S&P 500. The goal isn't to beat the market, but to match the market's performance. They would also note that this passive approach often results in lower internal fees compared to many actively managed funds. In summary, a finance expert acts as a tour guide through this world of accounts and products. They explain what each tool is designed to do, how it works, and the general pros and cons, empowering you to understand the components of a well-structured financial plan. In our next chapter, we will shift our focus to another critical area where an expert provides guidance: tax planning and how it integrates with your overall financial strategy. Hello and welcome back. So far on our journey, we have explored how a financial expert helps you organize your cash flow, build a solid foundation, and understand the tools of investing. Today, we're going to discuss a topic that touches every single one of those areas, yet is often overlooked until it's too late: tax planning. For many people, taxes are a once-a-year event, a scramble in the spring to gather documents and file a return. But a financial professional helps a client see that taxes are not a separate event. They are a continuous thread woven through every financial decision you make. The goal of tax planning is not about finding secret loopholes or engaging in complicated schemes. A professional's role is to educate you on how to be tax efficient. This simply means understanding the tax implications of your financial decisions, so you can structure them in a way that minimizes your tax burden over the long term, legally and ethically. Before we go any further, it is imperative to state this clearly. This information is for educational purposes only and is not tax or legal advice. Tax laws are complex and change frequently. You must consult with a qualified professional, such as a certified public accountant or a tax attorney, for advice specific to your situation. A financial expert's role in tax planning is primarily that of a strategist and coordinator. They look at your entire financial picture: your income, your investments, your retirement savings, your charitable goals, and help you understand how they interact from a tax perspective. They often work in collaboration with a tax preparer, like a CPA. While the CPA is the expert on filing your annual tax return correctly, the financial expert is focused on making tax-smart decisions all year round. One of the first concepts an expert would teach is the difference between tax deductions and tax credits. They would explain that a tax deduction is an expense that can lower your taxable income. For example, a contribution to a traditional IRA might be deductible.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
If you are in a 22% tax bracket, a $1,000 deduction would save you $220. A tax credit, on the other hand, is even more powerful. An expert would describe it as a dollar-for-dollar reduction of your actual tax bill. A $1,000 tax credit reduces your tax bill by the full $1,000. Their role is to make you aware that these exist and to encourage you to work with a tax professional to see which, if any, you might be eligible for. Next, a financial expert would help you understand the concept of tax-aware investing. As we discussed in a previous chapter, different account types have different tax treatments. The expert's guidance centers on a strategy called asset location. This is not about what you invest in, but where you hold those investments. For example, they would explain that investments that generate a lot of taxable income each year, like certain types of bonds or actively managed funds with high turnover, might be better suited for placement inside a tax-advantaged retirement account, like a 401k or IRA. Inside that account, the annual income and gains are sheltered from taxes, allowing them to compound more effectively. Conversely, they would explain that more tax-efficient investments, like index funds that don't trade frequently or stocks held for the long term, can be a better fit for a regular, taxable brokerage account. This is because long-term capital gains are often taxed at a lower rate than ordinary income. The expert's job is to educate you on this logic, so you can make informed structural decisions. Another key area is helping you navigate life events. A professional provides guidance on the potential tax implications of major milestones. Getting married, having a child, buying a home, or receiving an inheritance can all dramatically change your tax situation. An expert helps you anticipate these changes and plan accordingly, rather than being surprised when tax season arrives. Finally, a financial professional can be instrumental in long-term strategies like retirement and charitable giving. They will educate you on how withdrawals from different retirement accounts are taxed. For example, they'll remind you that money from a traditional 401k is typically taxed as ordinary income, while qualified withdrawals from a Roth 401k are tax-free. Understanding this can have a huge impact on how much spendable income you have in your later years. They help you think through a withdrawal strategy decades in advance. In essence, a financial expert integrates tax planning into your overall financial plan. They help you shift your perspective on taxes from a reactive, annual chore to a proactive, ongoing strategy, ensuring that you are not just focused on what your investments earn, but on what you ultimately get to keep. In our next chapter, we will move from planning for accumulation to planning for protection. We'll explore the world of insurance and how an expert helps you manage life's biggest risks. Hello and welcome back. Over the last several chapters, we've focused on building momentum, creating positive cash flow, developing an investment philosophy, and planning for tax efficiency. These are the engines of your financial plan, designed to move you forward. But what happens if something tries to knock you completely off the track? This is where a crucial and often overlooked part of financial planning comes in: risk management. A financial expert's role in this area is to help you build a financial fortress around the life you've created. Risk management is the defensive side of the plan. It's about identifying the potential events that could be financially catastrophic and taking thoughtful steps to protect yourself and your family. The primary tool for this is insurance. Now, a financial expert is not necessarily an insurance agent. Their objective is not to sell you a product. Instead, their role is that of a risk analyst. They provide an objective, 30,000-foot view of your life and help you ask the tough, what-if questions. Their goal is to help you understand your risks so you can make informed decisions about transferring that risk to an insurance company. Before we explore this, please note, this chapter is for educational purposes only. It is not a solicitation or recommendation to purchase any insurance product. Insurance policies are legal contracts with specific terms, conditions, and exclusions. For advice on your specific needs, you must consult with a licensed and qualified insurance professional. A financial expert typically guides a client through an analysis of 4 major categories of personal risk. The first is the risk to your life. The expert helps you answer the question: if you were to pass away prematurely, would anyone who relies on your income suffer a financial hardship? This isn't just a question for people with young children. It could be a spouse who depends on your income to pay the mortgage, a business partner, or even aging parents you support. The expert facilitates a calm, rational discussion to quantify this need. Together, you might calculate the amount needed to pay off debts, replace your income for a set number of years, and fund future goals like college education. Once the need is understood, the expert will then educate you on the basic concepts of life insurance. They would explain the two fundamental types: term insurance, which they would describe as providing coverage for a specific period, or term, like 20 or 30 years, and permanent insurance, which they would describe as providing lifelong coverage, often with an additional cash value component. The expert's role is simply to explain how each type works, its general pros and cons, so the client can have a knowledgeable conversation with an insurance specialist. The second area of risk is your ability to earn an income. An expert will often say that your ability to get up every day and earn money is your single most valuable financial asset. They then help you answer the question: if a serious illness or injury prevented you from working for months, or even years, how would you pay your bills? This is where they introduce the concept of disability insurance as paycheck protection. They help a client review any group disability coverage they might have through their employer, understand its limitations, and identify any potential gaps between what the policy would pay and what they would actually need to maintain their lifestyle. The third area of risk is your health. In the United States, the cost of medical care is a significant financial risk. The expert helps a client address the question: how are you prepared to handle the costs of everything from a routine doctor's visit to a major, unexpected surgery? A financial expert's role here is to integrate your health insurance costs, your monthly premiums, deductibles, and potential out-of-pocket maximums into your overall cash flow and financial plan. They stress that having adequate health coverage is a non-negotiable part of a sound financial plan, as it is the primary defense against a medical event leading to a financial disaster. Finally, the fourth area is the risk to your property and assets. An expert will help you analyze the question: if your home, car, or other valuables were damaged or destroyed, could you afford to repair or replace them? And critically, if you were found legally responsible for an accident that caused injury to someone else, are your assets protected? They encourage clients to look at their home and auto insurance not just as a legal requirement, but as a wealth protection tool. They will introduce the concept of liability coverage and explain why having sufficient coverage is essential to protect the savings and investments you have worked so hard to build. In all these areas, the financial expert acts as a strategist and educator. They help you see the big picture, identify your unique vulnerabilities, and understand the basic tools designed to mitigate them. They empower you to protect your journey forward. Now that we've covered how to protect your plan, our next chapter will return to one of the most important long-term goals of all: retirement. We'll explore how an expert helps you answer the question: how much is enough? Hello and welcome back. We've spent the last several chapters building and protecting your financial resources. Now we turn to the ultimate long-term goal for many Americans: retirement. For most people, this goal is defined by a single monumental question: how much money do I actually need to retire? The number can seem so large and distant that it feels overwhelming, even impossible. A financial expert's primary role in retirement planning is to be a guide and a facilitator. They take this enormous, intimidating question and help a client break it down into a series of smaller, more manageable pieces. Their process isn't about pulling a magic number out of the air. It's a thoughtful, collaborative journey designed to replace anxiety with a clear, actionable plan. As we navigate this important topic, please remember that this is an educational overview of a financial professional's process. It is not financial, investment, or retirement advice. A person's retirement needs are deeply personal, and you should always consult with a qualified professional to create a plan for your own life. The retirement planning process with an expert doesn't start with a spreadsheet or a calculator. It starts with a conversation about you. The first and most important step is to define your vision for retirement. An expert will ask open-ended questions to help you paint a detailed picture of what you want this next phase of life to look like. Questions like: what does an ideal week look like for you in retirement? Are you traveling the world, or are you spending quiet time at home with family? Do you see yourself pursuing expensive hobbies, like golf or boating? Do you plan to relocate to a different city or state, perhaps downsizing your home? The goal of this conversation is to get a real sense of the lifestyle you want to fund. A quiet retirement in a low-cost area has a very different price tag than a retirement filled with international travel and city living. Without this vision, any savings number is just a guess. Once that vision is established, the expert helps you translate it into an estimated annual cost. This is the second step, projecting your retirement expenses. They will often use your current budget as a starting point and help you think through how your spending might change. Some expenses, like commuting costs or the money you were saving for retirement, will likely disappear. Others, however, might increase. An expert will prompt you to think about categories like travel and, critically, healthcare. They help you realistically consider that as you age, medical costs are likely to become a more significant part of your budget. You may have heard of general guidelines, like the 80% rule, which suggests you'll need about 80% of your pre-retirement income to maintain your lifestyle. A professional will explain these rules of thumb but will stress that their true value is in helping you create a customized expense estimate based on your unique vision, not a generic percentage. The third step is to account for other sources of income you might have in retirement. For most Americans, the foundation of their retirement income is Social Security. A financial expert's role here is to demystify the system. They won't predict the future of the program, but they will guide you to the official Social Security Administration website to get your personalized benefit statement. They will then educate you on the implications of your claiming decision, explaining how your monthly benefit amount changes, depending on whether you start taking it early at age 62, at your full retirement age, or if you delay it until age 70. They help you understand the trade-offs of each choice. Next, they'll help you factor in any other income sources, like a pension if you are one of the fortunate few to have one. Once you have an estimated annual expense and an estimated annual income from sources like Social Security, the fourth step is to identify the gap. The expert helps you subtract your guaranteed income from your expenses. The amount that's left over is the amount that your personal retirement savings will need to generate for you each year. This leads to the final, crucial part of the calculation. To figure out the total savings you'll need, an expert might introduce you to an educational concept often used in the financial planning community, sometimes referred to as the 4% rule. They will explain this not as an ironclad law, but as a guideline to help you get a sense of a reasonable savings target. The concept suggests that you could withdraw 4% of your portfolio's value in your first year of retirement, and then adjust that amount for inflation in subsequent years, with a high probability of your money lasting for at least 30 years. A professional would be very clear that this is just a starting point for a conversation, and is not a guarantee. They would discuss the factors that can impact this guideline, like market conditions and longevity. But by using this concept, they can help you turn your annual income gap into a tangible long-term savings goal. By walking through this structured process, a financial expert transforms the overwhelming question of how much into a logical, personalized, and achievable target. In our next chapter, we'll discuss the strategies and actions an expert helps you implement to actually work toward that target, focusing on the accumulation phase of your financial life. Hello and welcome back. In our last chapter, we demystified the process of figuring out your retirement number. A financial expert helps you transform that big, intimidating question into a tangible and personalized savings target. But once you have that target on the horizon, how do you actually build a plan to reach it? This is the accumulation phase, the decades-long journey of systematically saving and investing to build the resources you'll need for your future. During this phase, a financial expert's role shifts to that of a coach, a strategist, and an accountability partner. They help you design a disciplined savings plan and understand the long-term investment strategies that will power your journey. Their guidance is focused on creating a consistent and sustainable process, not on trying to time the market or chase short-term gains. As we discuss these strategies, please remember this is for educational purposes only and is not investment advice. The path to retirement is unique for every individual, and you should always work with a qualified professional to build a plan suited to your personal circumstances. The first and most fundamental strategy an expert will help a client implement is to make saving automatic. They understand that willpower alone is often not enough. A professional will help you set up automated contributions from your paycheck into your retirement accounts, like a 401k, or from your bank account into an IRA. They'll explain that by paying yourself first, before you have a chance to spend the money elsewhere, you transform saving from a decision you have to make every month into a seamless habit. This consistency is the bedrock of any successful long-term plan. Next, the expert will work with you to determine an appropriate savings rate. This goes back to the goal you calculated. If your target is 30 years away, the expert can help you calculate the approximate percentage of your income you need to save each year to be on track. They provide the mathematical clarity. They might show you illustrations of how different savings rates, saving 10%, 15%, or 20% of your income, could impact your final outcome. The goal is to help you find a rate that is both ambitious enough to meet your goals and realistic enough to fit within your current budget. With the savings plan in motion, the conversation turns to investment strategy for the long term. Here, an expert educates a client on the importance of maintaining a strategic asset allocation, which we discussed in a previous chapter. They will help you select an allocation of stocks, bonds, and other assets that aligns with your long-term time horizon and your personal risk tolerance. A key concept they might introduce for retirement savers is the idea of a glide path. They would explain this as a strategy for gradually and automatically shifting your investment mix over time. When you are young and many decades away from retirement, your asset allocation might be more aggressive, with a higher percentage in stocks to emphasize growth. The expert would explain that as you get closer to your retirement date, your landing, the glide path strategy would systematically reduce your allocation to stocks and increase your allocation to more conservative investments like bonds. The purpose, they would clarify, is to reduce volatility and help preserve the capital you've built as you near the date you'll need to start using it. They would note that some investment products, like target date funds, are designed to follow this type of glide path automatically. Finally, a crucial role for the expert during the decades-long accumulation phase is to be a behavioral coach. They provide the steady hand and the long-term perspective needed to navigate market volatility. When markets are soaring, they can offer a voice of reason to avoid irrational exuberance or taking on too much risk. More importantly, when markets are falling, they are there to remind you of your long-term plan. They help you avoid the common and costly mistake of selling out of fear at the bottom of the market, turning a temporary paper loss into a permanent one. They encourage you to stay the course, stick to your plan, and see market downturns as a natural part of the long-term investing cycle. Throughout this journey, an expert will also help you conduct periodic reviews, perhaps annually or every few years, to make sure your plan is still on track and aligned with your life, making adjustments as your income, goals, or family situation changes. In our next chapter, we will shift our focus to another major financial goal that often runs parallel to retirement savings: planning for education costs. Hello and welcome back. For many families across the United States, there is another major financial goal that often runs on a parallel track with retirement savings: planning for a child's or grandchild's education. The rising cost of higher education can feel like a daunting challenge, and many people wonder how they can possibly save for it without compromising their own long-term financial security. This is where a financial expert plays a critical role. They act as a strategic partner, helping a family create a clear, intentional, and realistic plan to address this goal. Their job is to help you navigate the various savings options available, understand the financial trade-offs, and integrate your education savings goals into your broader financial life without letting it derail your own retirement. Before we explore this process, please remember that this content is for educational purposes only. It is not financial, investment, or tax advice. The rules governing education savings accounts are complex and can vary significantly from state to state. It is essential to consult with qualified financial and tax professionals for guidance on your specific situation. The first step an expert takes with a client, much like with retirement planning, is to quantify the goal. They help the family move from a vague desire to save for college to a more concrete savings target. This involves a thoughtful discussion around key questions. What is your family's philosophy on funding education? Is the goal to cover 100% of the costs for a 4-year university, or to fund a portion with the expectation that the student will contribute through scholarships, work, or loans? Are you planning for a public in-state university or a private one? Once these foundational questions are discussed, the expert guides the client in researching the current costs for tuition, fees, room, and board. Then they introduce a critical concept: education inflation. They will explain that historically, the cost of college has risen at a much faster rate than standard inflation. By projecting these costs forward to the year the child will actually attend college, an expert helps the family arrive at a realistic, and often eye-opening, savings target. With a target in place, the second step is for the expert to educate the client on the specific tools designed for education savings. In the United States, the most prominent of these is the 529 plan. An expert would describe a 529 plan as a tax-advantaged savings account sponsored by states that is specifically designed to encourage saving for future education costs. They would explain the key features from an educational standpoint. First are the potential tax benefits. An expert would clarify that while contributions are typically not deductible on your federal tax return, many states offer a state tax deduction or credit for contributions made to their specific plan. They would then highlight the primary benefit. The money invested within a 529 plan can grow on a tax-deferred basis. And most importantly, withdrawals are completely tax-free at the federal level when used for qualified education expenses, which can include tuition, books, supplies, and room and board. The expert would also explain other important features, such as the high contribution limits and the fact that the account owner, typically the parent or grandparent, maintains control over the funds. This means the student cannot access the money for non-educational purposes. A professional would also make a client aware of other potential tools, such as a Coverdell Education Savings Account, or ESA. They would describe it as another tax-advantaged account but would point out its key differences, such as much lower annual contribution limits and income restrictions for contributors, but with the added flexibility of being usable for qualified K through 12 expenses, not just higher education. Finally, they would explain the nature of custodial accounts, known as UTMAs or UGMAs. They would describe these as accounts that hold assets for a minor, but would be very clear in educating the client on the critical trade-off. Once the child reaches the age of legal adulthood in their state, the money becomes their legal property to use as they see fit, with no requirement that it be spent on education. The third and most crucial step is helping the family integrate the education savings plan with their other financial priorities. Here, an expert often acts as a crucial voice of reason. They might use the familiar airplane oxygen mask analogy, reminding the client of the importance of securing their own retirement first. The logic they would explain is simple. A student can get scholarships, grants, or loans for college, but there are no loans for retirement. An expert helps a family find the right balance, determining a savings amount for education that is meaningful, but does not come at the expense of their own long-term financial security. In our next chapter, we will transition to a topic that becomes increasingly important as people build wealth and start thinking about their legacy: the fundamentals of estate planning. Hello and welcome back. As we progress through the journey of a financial life, our focus naturally begins to shift. We move not only from building and protecting wealth for ourselves, but to thinking about the legacy we want to leave behind. This brings us to the topic of estate planning. For many, this sounds like a subject reserved only for the very wealthy, but that is a common misconception. At its core, estate planning is simply about deciding how you want your assets to be managed and distributed both during your life if you're unable to make decisions, and after you're gone. A financial expert's role in this area is not to create legal documents or provide legal advice. That is the exclusive role of a qualified attorney. Instead, the financial expert acts as a facilitator, an educator, and a financial coordinator. They help you get organized and understand the basic concepts so you can have a more productive and efficient conversation with your legal team. They help ensure that your financial plan and your legal plan are perfectly aligned. It is absolutely critical to state this up front. This chapter is for informational and educational purposes only. It is not legal or tax advice. Estate planning involves complex legal documents and significant tax implications. You must consult with a qualified estate planning attorney and a tax professional to create a plan that is valid in your state and appropriate for your circumstances. The first step an expert takes is to help a client create a comprehensive inventory of their estate. They help you list out everything you own: bank accounts, investment accounts, retirement funds, real estate, life insurance policies, business interests, and even valuable personal property. They also help you organize how these assets are titled, whether they're in your individual name, held jointly with a spouse, or have designated beneficiaries. This financial snapshot is the foundational document an attorney will need to begin crafting your plan. Once you are organized, the expert will educate you on the basic building blocks of a typical estate plan, so you understand what your attorney will be discussing with you. The first document they would explain is the last will and testament. They would describe a will as the core instruction manual for what happens after you pass away. It's where you name who you want to inherit your property, designate a guardian for any minor children, and appoint an executor, the person or institution you trust to carry out your will's instructions. An expert would also explain the concept of probate, which is the legal court process through which a will is validated and the estate is settled. Next, they might introduce the concept of a trust. They would describe a trust as a legal entity that can hold and manage assets on behalf of beneficiaries. A common type they would explain is a revocable living trust. They would clarify that with this tool, you can transfer your assets into the trust during your lifetime and continue to control them as the trustee. The expert would highlight that a primary reason people use trusts, as an attorney would further explain, is to avoid the time and expense of the public probate process. The expert would then shift the conversation to planning for incapacity. What happens if you are alive but unable to make decisions for yourself? They would explain 2 critical documents for this scenario. The first is a durable power of attorney for finances. This document is described as a legal tool where you appoint a trusted person, called an agent, to manage your financial affairs if you cannot. This could include paying bills, filing taxes, and managing investments. The second is an advance healthcare directive, which may also be called a healthcare power of attorney or living will. An expert would explain that this document allows you to appoint an agent to make medical decisions on your behalf and to outline your wishes regarding end-of-life medical care. The financial expert's role is to ensure these concepts make sense to you and, crucially, that your financial accounts are structured to align with your legal documents. For example, they will help you review and update the beneficiaries you have listed on your retirement accounts and life insurance policies. They will explain that these beneficiary designations are powerful legal contracts that typically override what is written in a will. Ensuring they are correct is a critical step in making sure your assets go to the right people. In essence, a financial expert helps you prepare for the estate planning process, ensuring the financial side of your life is in perfect order, so your attorney can build the most effective legal structure to achieve your legacy goals. In our next chapter, we will discuss the human side of financial planning, how an expert can help families navigate financial conversations and facilitate the transfer of knowledge to the next generation. Hello and welcome back. Throughout this series, we have explored the many technical aspects of a financial expert's job, from budgeting and investing to insurance and estate planning. But one of the most important, and least discussed, roles a financial expert plays has little to do with spreadsheets or market charts. It has to do with people. At its heart, personal finance is deeply personal and emotional, and it is inextricably linked with our closest relationships. A significant, though often unseen, part of a professional's value is in serving as a skilled and neutral facilitator. They create a safe space for families to navigate sensitive financial conversations that are often too difficult to have on their own. Their goal is to help family members align on their shared values and goals, fostering communication and reducing conflict. As we discuss these topics, please remember this is an educational overview. It is not financial, family, or psychological advice. Navigating family dynamics can be complex, and you should consider consulting with appropriate professionals for your specific situation. For many couples, a financial expert can be an invaluable third party. It's a well-known fact that disagreements over money are a leading cause of stress in relationships. This often happens because each partner comes into the relationship with a different money mindset, a set of beliefs and habits about finances learned from their own upbringing. One person might be a natural saver, while the other might be more inclined to spend freely. Neither approach is inherently right or wrong, but the difference can create friction. An expert facilitates a conversation that moves beyond blame. They don't take sides. Instead, they help the couple focus on their shared future by starting with a discussion of their common goals. What do we want to achieve together in the next 5, 10, 20 years? They create a foundation of unity. From there, they can help the couple see how their individual financial habits can be merged into a unified plan that serves those shared dreams. They provide the structure and objectivity to turn a potential argument into a productive, collaborative planning session. This role as a facilitator often extends across generations. Building on the estate planning conversations we discussed in the last chapter, an expert can help aging parents talk to their adult children about their wishes. These can be difficult conversations, touching on inheritance, long-term care, and end-of-life plans. Having a neutral professional in the room can be incredibly helpful. The expert can guide the conversation, explain complex financial and legal concepts in simple terms, and ensure the focus remains on clarity and understanding, not on emotion. This process can be a profound gift to the next generation, giving them a clear roadmap and preventing the confusion and potential conflict that can arise when these topics are left unspoken. Furthermore, a forward-thinking expert plays a vital role in helping clients prepare the next generation for financial responsibility. This isn't about giving investment advice to a teenager, but about coaching the parents on how to become effective financial mentors for their children. An expert can provide a framework and resources to help parents teach age-appropriate financial lessons. For young children, this might be as simple as introducing the 3-jar system: 1 jar for saving, 1 for spending, and 1 for sharing or giving. For preteens, it might be about helping them open their first savings account and understanding the difference between a debit card and a credit card. For older teenagers and young adults, an expert might help the parents explain more advanced concepts, such as the power of compound interest, the importance of starting to save for retirement early, and the dangers of high-interest debt. The expert's role is to empower their clients to pass on not just their wealth, but also their wisdom, ensuring the family's financial well-being can be sustained for generations to come.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
In our next chapter, we will continue this theme of legacy and purpose by exploring how a financial expert can assist clients who wish to incorporate charitable giving into their overall financial plan. Hello and welcome back. As individuals and families build a successful financial life, many find that their focus expands beyond their own needs to a desire to make a positive impact on the world around them. This is the heart of philanthropy and charitable giving. For many, giving back is a core personal value, and a financial expert can play a vital role in helping clients integrate this value directly into their financial plan. The role of an expert in charitable planning goes far beyond simply reminding a client to write a check. It's about helping them become more intentional, strategic, and impactful with their generosity. They help clients align their giving with their passions and structure that giving in a way that can be more efficient and sustainable over the long term. It is crucial to state that this discussion is for educational purposes only. It is not financial, legal, or tax advice. The strategies and regulations surrounding charitable giving are complex and highly individualized. You must consult with your team of qualified financial, legal, and tax professionals to determine the approach that is right for you. A financial expert's first step in a charitable planning conversation is not about money, but about meaning. They facilitate a discovery process to help the client answer the question: what do you want to accomplish with your giving? Are you passionate about supporting education, the arts, medical research, or your local community? Do you want to make an impact now, or create a legacy of giving that will last for generations? By clarifying the why behind the desire to give, the expert helps ensure that the financial strategy ultimately serves the client's deepest values. Once the charitable mission is clear, the expert can then educate the client on the various ways to execute that mission. They explain the how. The most straightforward method, of course, is direct giving of cash. An expert's role here is to help the client integrate this giving into their annual budget, and to explain the importance of proper record keeping for tax purposes. However, they can also introduce more strategic ways of giving. For clients with investments, an expert might educate them on the concept of donating long-term appreciated assets, like stocks or mutual funds that have grown in value. They would explain the potential tax efficiency of this strategy. A professional would describe that, under current tax law, by donating the appreciated asset directly to a qualified charity, the donor can generally avoid paying the capital gains tax they would have owed if they had sold the asset first. Additionally, they may be eligible to take a charitable deduction for the full fair market value of the asset. This is a concept they would then encourage the client to discuss in detail with their tax advisor. For clients who want to streamline their giving, an expert might explain a tool called a donor-advised fund, or a DAF. They would describe a DAF as a sort of charitable investment account. The expert would explain the mechanics. You can make a contribution of cash or securities to the DAF, for which you may be eligible for an immediate tax deduction. That contribution is then invested and can potentially grow tax-free. From the fund, you can then recommend grants to the charities of your choice over time. They would explain its role as a tool for organizing and managing your philanthropy. For clients who are in or nearing retirement, a professional might educate them on a strategy known as a qualified charitable distribution, or QCD. They would explain that for individuals over a certain age, current IRS rules may allow them to make a financial gift directly from their traditional IRA to a qualified charity. A key feature they would highlight is that this distribution can often be used to satisfy their required minimum distribution for the year, without the amount being included in their taxable income. In all of these scenarios, the financial expert acts as an educator and a coordinator. For more advanced strategies, they work as part of a team, collaborating with the client's attorney and CPA to ensure that the charitable plan is legally sound, tax efficient, and fully integrated with their overall estate and financial plans. In our next chapter, we will discuss the ongoing nature of the client-expert relationship, focusing on the importance of regular reviews and adapting your financial plan as life inevitably changes. Hello and welcome back. Throughout this series, we have journeyed through the comprehensive process of building a financial plan, from the first steps of budgeting to the long-range goals of retirement and estate planning. But a common misconception is that a financial plan once created is a static document, a finished product to be filed away. The reality is that a financial plan is not a photograph, it's a living, breathing roadmap. And a financial expert's most significant value is often found not just in helping you draw the initial map, but in helping you navigate the journey, recalculating the route as life unfolds. This is the purpose of the ongoing client-expert relationship and the periodic review process. It's a commitment to ensuring your financial plan remains relevant and effective as your life, your goals, and the world around you inevitably change. As we discuss this process, please remember this is an educational overview. It is not financial or investment advice. The decision to review or alter a financial plan is a significant one, and should be made in consultation with qualified professionals who understand your complete personal situation. A periodic review, often conducted annually, is far more than just a checkup on investment performance. It is a structured conversation designed to answer one fundamental question: is your financial plan still aligned with your life? An expert will typically guide this conversation through several key areas. The first and most important area is a review of your life. An expert will ask what has changed over the past year. Did you get married, divorced, or welcome a new child into your family? Did you change jobs, receive a significant raise, or start a new business? Have you or a family member experienced a significant health event? Each of these life changes has financial ripples. A new baby may prompt a conversation about starting an education fund. A new job brings a new 401k plan and new employee benefits to consider. An expert helps you connect these life events to the specific, practical adjustments needed in your financial plan. The second area of focus is a reassessment of your goals. The person you are today may have different priorities than the person you were 5 years ago. An expert facilitates a conversation to see if your goals have shifted. Is retiring early still your number one priority? Or has a new dream, like buying a vacation home, or helping an adult child with a down payment, become more important? Life experiences change our perspectives, and a good financial plan must be flexible enough to change with them. The expert helps you clarify your current priorities and adjust the plan to aim at these new or refined targets. Of course, a review does involve checking your financial progress. This is the accountability part of the relationship. The expert will help you review your savings rate, your progress on paying down debt, and the performance of your investment portfolio. When it comes to investments, the conversation isn't about chasing the latest hot stock. A professional helps you understand your portfolio's performance in the context of your long-term goals and the behavior of the overall market. The key question is not, did we beat the market last quarter? But does our long-term investment strategy remain sound and appropriate for our goals? This often leads to a discussion about rebalancing. An expert would educate you on this concept. They would explain that as different investments grow at different rates, your original asset allocation, your chosen mix of stocks and bonds, can drift over time. Rebalancing is simply the disciplined process of periodically selling some of the assets that have grown significantly and buying more of those that haven't, in order to return your portfolio to its original, intended allocation. They would describe it as a fundamental risk management strategy. Finally, an expert helps you adapt to external changes. Tax laws can be revised. New types of investment accounts might be created. Your employer might change its benefits package. A professional stays on top of these developments and helps you understand how they might impact your personal financial situation. Ultimately, the ongoing relationship with a financial expert is about having a long-term thinking partner. It's about having a trusted resource who understands your complete financial history, your personal values, and your family dynamics, and who can provide objective guidance through all of life's transitions, both planned and unplanned. Hello and welcome to the final chapter of our series. Over the last 14 chapters, we have explored the vast and varied role of a U.S. finance expert. We've journeyed from the fundamentals of cash flow and debt management to the complexities of investing, tax strategy, risk management, and legacy planning. The goal has been to pull back the curtain and demystify what a financial professional actually does, showing how they can serve as a guide through a world that can often feel complicated and overwhelming. Having come this far, you might now be asking yourself, how do I find the right guide for my own journey? This final chapter is designed to provide you with a framework for that process. It's about how to search for, evaluate, and ultimately choose a qualified professional who is the right fit for you and your family. Before we begin, this final reminder is the most important of all. This information is for educational purposes only and is not a recommendation or endorsement of any specific financial professional, designation, or firm. The process of selecting an expert is a deeply personal one, and it is essential that you conduct your own thorough research and due diligence. The first step in your search is to understand that, as we mentioned in Chapter 1, finance expert is an umbrella term. Professionals often hold specific credentials or designations that signify they have met certain standards of education, ethics, and experience. An expert would encourage you to become familiar with some of the most recognized ones. For instance, you will likely encounter the Certified Financial Planner, or CFP mark. A professional would explain that this is a formal designation for planners who have completed extensive training, passed a comprehensive exam, and must adhere to a strict code of ethics, including a fiduciary standard of care. A professional would also explain what the term fiduciary means. It is a legal and ethical obligation to act in the best interest of another party. When a financial advisor operates as a fiduciary, they must put your interests ahead of their own. Other common credentials include the Chartered Financial Analyst, or CFA, which is a globally respected designation focused on investment analysis, and the Certified Public Accountant, or CPA, who are experts in tax. Some CPAs also earn a Personal Financial Specialist, or PFS, credential to denote their expertise in financial planning. Your task is to research what these credentials mean and decide which type of expertise best aligns with your needs. Next, it is critical to understand how a professional is paid, as this can influence the advice they give. An expert would educate you on the primary compensation models. The first is fee-only. This means the professional is compensated solely by the fees their clients pay, which could be an hourly rate, a flat fee for a project, or a percentage of the assets they manage for you. The second model is commission-based, where the professional earns their income from commissions paid by third-party companies for selling specific financial products. The third is a hybrid model, often called fee-based, where a professional might charge a fee for their planning services, but also earn commissions on products. There is no single best model, but it is absolutely essential that you understand exactly how any professional you consider working with is compensated. Once you have a basic understanding of credentials and compensation, the next step is the interview process. Think of it like hiring someone for a very important, long-term job. A savvy consumer would come prepared with a list of questions. Consider asking things like, are you required to act as a fiduciary for me at all times? How are you compensated? Can you please provide that to me in writing? What are your qualifications and who is your typical client? What is your overall investment philosophy? And finally, could you describe your process for working with a new client? Beyond the technical answers, pay attention to the human element. Is this a person you feel comfortable talking to about your life and your money? Do they explain complex topics in a way you can understand? Do you feel heard and respected? A financial planning relationship is built on trust and communication. The right technical qualifications are essential, but the right personal fit is just as important. Our journey through this series has been about replacing financial anxiety with knowledge and confidence. We've seen that the ultimate goal of a good financial expert is not to create dependency, but to empower you with the clarity and organization needed to take control of your financial life and pursue your goals with intention. The journey to financial well-being is a marathon, not a sprint, but with a clear plan and a trusted guide. It is a journey you can navigate with confidence. Thank you for joining us.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.